Yeah, so point one, point two, we have point three, we had what? Like I said, sometimes we may have what? That breakout candle. So in this kind of scenario, you may wonder which of the candles would you consider as the breakout candle? This one here, right? This particular one here is what we would consider as the breakout candle. So in trading, what do you do when you have that breakout candle? In a real market scenario, what do you do when you have this breakout candle right here, right? So this is what you do. This is how it's going to look like. You're trading, you've marked up your chart, you're watching. Kojo says, watch out for a third touch of the trend line, point one, point two, point three. But this point three didn't have a smooth touch. There was just one big candle that ran through it. So you're wondering, what am I going to do from now? How am I going to even find any position here now? Do I start shorting it, or do I consider this as a broken trend line and then wait for it to head towards this region, right? Head towards this next region, which is the previous sort of a resistance, or what do I do? You may easily wonder what you should do next. But what you do when you have this kind of scenario is to pick your horizontal ray, right? And then put it right on top of the breakout candle, the wick on top of that breakout candle, right? Once you put that on top of that breakout candle, next is the rule of thumb is no candle should close strongly above that breakout candle. Remember again that this is also a strategy, right? So anything that teach you don't take it as theoretical or some YouTube thing, right? Remember that it is a strategy you're learning, right? It is a strategy you're learning. It is not something in a textbook or somebody's thing that you're learning. It is my strategy you're learning. Once we have point one, point two, point three, breakout candle, I put that horizontal line there, then I'm looking that no candle should close strongly above that region again, right? So if you watch here, what happens subsequently? No candle close doesn't mean a wick can run through. If a wick runs through, it is not a strong body closure. What I'm saying is we don't want to have a strong body closure, not a wick, right? There's a difference between wick and body, and I don't think at this level I'm supposed to explain the difference to you. So we're saying that we don't want to see a body closure, not a wick closure. You could have wicks run through that level, but the body will come back and close beneath it. It is still valid. You could have a long wick run through whatever, even if the wick is up to here and then the body comes back to close it down, it is still what valid, right? It's a part of the rule of thumb. So let's look at this scenario. What happens here? A push up, a push down, and then another push up, spikes through it, doesn't close above it, and eventually what runs down like that, right? So here's where would be what my point of interest for a shot, and then everybody would wonder what I saw to go short here, but it is just how the strategy works, right? You'd easily wonder, how did you know that this thing was going to drop here, right? Everything comes up with confidence. You may not be confident the first time you're trying this, right? You may not be confident the second time, 1 week on, 2 weeks on, whatever it is. It depends on your appetite for risk taking, though. But as far as I'm concerned, the more you stick with it, the more you're practicing, the more you're giving it that reverence, right? That respect, that discipline, that hard work, that monitoring, you naturally develop that confidence around it, and then you develop that edge around it, and then you develop also that trust around it, right? You begin to trust it, you begin to see things clearly, and then you begin to see that it does work, so you want to what, capitalize on it and then make some money from it. But initially you may be in some doubt. Once it runs to your boundary, is it going to respect, is it going to break, and so on and so forth, right? So that is it when it comes to particularly how to trade the trend line, right? The third touch on the trend line. Let's take other scenarios as well, right? Let's take other scenarios, similar scenarios. What time frame do you consider? The time frame you drew the trend line on. If I drew my trend line on the 4-hour, that is what I would consider. And then I've told you guys that I do predominantly my analysis on the 4-hour time frame, right? Including drawing my trend lines. But I draw my trend line on the 4-hour. If you look at this, we had sort of a very perfect touch on the trend line. So here, there wasn't even any predominant breakout candle, but the one that we can consider is just this little one here, right? That sort of ran through with that spike, and clearly you can see that what, after that touch, it ran back into the trend, and then what, it trickled down, right? So this is even clearly a simple, straightforward setup, which we had a trade on, right? So this one we had a trade on about last 2 weeks, 3 weeks, there about something like that. We had AUD USD short, and then this is part of the confluence we used to have that short entry, right? That short entry with our stop loss just above that range like that, and then we held it. So very good trade, about almost 200 pips if you had the patience to hold it through, right? Very straightforward setup. Let's see another one as well. Let's just see how. So let's see other ones that didn't work though, right? Let's see other ones that didn't work though. Let's say a scenario like this. So we have what, 0.1 all the way down there, right? All the way from the very bottom, I have a 0.1. I believe you guys can see that 0.1 all the way here. 0.2, and then we tapped into 0.3. But upon tapping into 0.3, we had what? The breakout candle. So the rule of thumb continues. What do we do on that breakout candle? We put that horizontal ray there. And then we say no candle should close beneath this horizontal ray. So what happens? You're gonna keep close monitoring here to see if you're gonna find an entry. How are you gonna find the entry? That's when we touch on candlestick confirmations, which we'll do most likely later today or tomorrow, right? So what happens? There's another doji, and there's a big break which closes beneath it. It's a body. The body closes beneath it, right? It is not a wick. It's the actual body that closes. So yeah, automatically I consider that the trend line touch invalidated. Then what happens? We had another doji and a big push on the downside. So there's no way I'm going to be taking even a trade here for a long. I'll just avoid that trade and then see what I could have done next, right? What could I have done next in this kind of scenario? Is me watching how this lows here will survive that massive push on the downside, right? And what happens subsequently with this market? Just trades on and on and on like that, and then breaks that low, right? So this is how we close Friday. So let's see how next week unfolds. But basically, once this place doesn't work, I totally avoid the trade. If here had held as a support, right? Let's say it tapped here, it didn't break, there was some rejections here, blah blah blah, right? Based on my candlestick confirmations, I'd have been able to catch a long trade from here and then hopefully watch it run all the way back up. But since we broke to here and then we're just being choppy here, and I have to avoid this pair until a clear direction is established, right? So now all I have to do is just let it slide, right? But you can see a fill in the trend line touch, right? Now let's look at other scenarios as well. So even a fill, you are saved from taking a loss on a fill based on the rule of thumb, right? You are saved from taking a loss even on the fill. Let me check this inner trend line here on the 1.2, 1.3. Sometimes you have even trickier ones, right? Something like this being a tricky one. But if you learn correlation and cross-referencing, then it wouldn't even be tricky, right? So because this one, if you're watching this, what happens based on what I've taught you, you don't want to put your horizontal ray here. What happens? There's another close on the upside, a doji, and then a bearish candle, right? But if you look at this period in the market, which is New Zealand Japanese yen, right? It was the same time that we had this Australian Japanese yen here, and then it was the same time that we had this Aussie dollar setup here, and then it was the same time that we had which one again? New Zealand card setup as well, right? New Zealand card, I think. So cross-reference wise, Aussie dollar, New Zealand dollar were just showing extreme sign of weakness, right? Which we will learn in depth when we get to the cross-referencing part. So even though that trend line rule of thumb was a little bit breached, right? Once you come to learn candlestick confirmations and then you realize that, okay, Aussie dollar setup wasn't breached, Aussie dollar Japanese yen setup wasn't breached, but New Zealand Japanese yen, you know, they are more like a twin pair, Aussie dollar, New Zealand dollar. That's why I've arranged them here. I'll show you exactly the meaning or the reasoning into how I have arranged my currency pairs here, right? I use them strongly for cross-referencing. So, right, the trend line might have been invalidated, but you'd come to learn when we get into candlestick confirmation that this setup right here, which has to do with what we call the evening star formation, had confirmed somewhat a bearish trend coming in on this one. So it may be a little bit tricky. You may want to avoid it, but if you believe strongly in your cross-referencing, it could be a position you may add up, right? But initially, after that push on the upside like this, there's no way I'll be thinking of a short. That's how you'll be looking at it, right? A push up, then another candle. There's no way I'll think of shorting this. I'll literally just avoid it and then be in anticipation that this thing will push even further up. But once we have like that one candle push down like that, and I start reconsidering my thoughts, and then I'll go and look through the other currency pairs that correlate with New Zealand Japanese yen, and then see if I'll change my mind and find a short on it or not, right? Subsequently, you can see there's a continuous push on the downside, push back up, retest, and then the market just trades down and down and down like that. Still picking other scenarios. So here, what happens after that push down? We readjust, like I told you, right? So if you readjust this, this is what you'd have seen. And then what do you want to do? You put your what's it, horizontal ray here. You want to monitor how the market trades beneath it, right? Spikes down, doji consolidation, sort of basically stuck in this range. You don't want to trade a market that is stuck in a range, right? So after a long time, push up, push down, blah blah blah, closes above it, then you want to reconsider what is really going on in this chart. So this is typically a chart that I would avoid, right? I'll show you when we talk about candlestick confirmations. And then I would want to even wait and wait and wait for more clarity before I take any trade. You know, you must also remember that there are so many currency pairs you are watching at a time. You're not trading just one or two. So if one currency pair doesn't align with your thought process, your bias, your reasoning into taking a position, right? Then you want to do what? You want to typically avoid that setup, right? You want to typically, until one way or the other, it builds up in a way that you believe in, right? Before you want to take a trade. If you look at this, subsequently, what happens? Even if you had avoided that initial setup I was showing you, you had what? Somewhat a push here, right? And then you have what? At least a point two now, right? Point one, point two. I would have typically expected this thing to even push further down, right? And then see if we're going to what? Push up and then push down. But you can clearly see that even from here, right? There's what? A continuous tap into it, just like that. Doesn't trade above it, pushes down, and then what? The trend just continues all the way down, right? A rule is a rule, right? Don't be picky with the rule, right? Here is still 0.1. Here, that small wick you're seeing here still establishes itself as what? 0.2. And then the next one next to it is what? A 0.3, right? You have to be clear with it. It's a rule. Just stick with it, right? Look at it clearly. Don't say, oh, they are too close, so I don't think that this one will qualify as 0.3, or don't say, oh, this one I just pushed up. Once you have that 1, 2, 3, you consider it, right? So have that in mind as well. I have to try and pick out the ones that have got like that breakout, more of a breakout scenario, and then see how I would have reacted with those breakout scenarios. There's one here. There's one breakout scenario here. If you backtest GBP USD, if you backtest on GBP USD around these regions, right? You have 0.1, 0.2, 0.3. You can clearly see what this candle establishes itself as a breakout candle. You put what your horizontal ray there, you put your rectangular thing there, say no candle should close above it. Okay, you see spike run through what? This is 0.1, this is 0.2, and the 0.3, and eventually what runs back into it, and then what happens? We trade all the way down, right? So eventually a trend line was validated, right? Let me show you another scenario also from Aussie dollar card that happened some couple of months back, right? These are certain prime setups that I traded during those periods, right? Look at Aussie dollar card, and then I switch all the way back up. And it's a long time that thing happened, so we're gonna go a little bit further into the chart. somewhere around here. It was a very, very brilliant setup. Point 1, point 2, point 3. Can you see that? And we have what? This breakout candle here. We put our horizontal ray beneath it. Then we keep a close eye here. What happens? Rejection, runs back into it. And then from here, a massive spike on the upside, right? How much in pips was this? Over 200 pips, right? So it's pretty easy, pretty straightforward to catch great trade setups, great amount of pips, risking very, very, very little. Just if you have the right knowledge on how to trade the trend line, especially the third touch of the trend line, right? Pretty easy, straightforward way to catch great moves on the market. Now I'm going to go a little into adding Fibonacci now, right? So just like I explained yesterday, we're just going to touch on it again before we look at real market scenarios. I said the market doesn't just move all the way up like that. What does it do? It moves in waves, pushes up, retraces a bit, hits some level, nobody knows which level. It could be 50, 61.8, 78, continues up, hits some level, it starts to retrace again, and then continues up, and so on and so forth, right? So as a trader, you always want to anticipate what the market could do anytime it gets into any Fibonacci range. So this is how my Fibonacci actually looks like, right? I actually change the whole view of my Fibonacci, and this is the setting though. You can take a screenshot of the settings, you can take a picture of it, whatever you want to do. This is the top part, and then this is the bottom, right? I use a percentage, the label is at the right and is at the middle, right? And then these are my Fibonacci levels, and then the colors I use. So in trading, like I told you, the exchange rates are not just random up and down movement. They are sort of like a marketplace where transactions are really bargained, right? On a retail level of things, you don't get to experience that thrill, right? But on the institutional level, then those are the things that kind of go on there, right? In the sense that people would quote exchange rates, like let's say somebody wants to buy Aussie dollar card, like Aussie dollar card 94.50, right? Then nobody would want to trade in that exchange rate. But once they are okay with that exchange rate, then they would also come in with what their orders and take maybe 5 million of that, 10 million of that, whatever of that, right? So in the bigger picture, we have what we call premium pricing and then discounted pricing, right? So I just basically use my Fibonacci to measure retracement into a possible range in which the market could dip in for a better bargain before a continuation in a major trend, right? So if you look at like a scenario, let's start from here, where we're just waiting on higher high, higher low formations, right? All the way from here, the market was extremely choppy and wasn't a good condition to want to find a trade. So in this kind of typical scenario, swing trader, you must avoid this kind of market, right? It's just going up, down, up, down. It's for scalpers, people that want to quickly come in, make some 10 pips, 20 pips. They are okay, they come out, scalp it down. It's for them, right? But as a swing trader, you don't want to be delving into a market like this. But continuously monitoring this, you can see that at some point there was a huge liquidity run in this, right? Where you consider that liquidity to start from here and then what it ended here, right? So here becomes what 100, and then here becomes a 0, right? So this is your swing point. What you could call your swing point A, and then swing point what B. And you can see what we run all the way from here to here, right? So after running from here to here, what would you consider this to be? A retracement, right? A pullback of this what initial move, right? But as it is pulling back, how are you going to even know where it could potentially stop before it continues? Because predominantly you can see that this trend is what in an uptrend. We're just going up and down, just creating lower high low formations and so on and so forth, right? So what do? You pick your Fibonacci to start from the very bottom, pull it onto the top, right? And then any price when we are looking for when is it we are in an uptrend, right? Let me take it again. When we are in an uptrend, any price that retraces beneath the 50%, that's what we call the discounted price, right? So it means that what the exchange rate is here, which is around the 9.640, right? But it has been discounted past what the 50%, which is what 9 point what 0. This one is 0.964, and there's a 0.954, right? A reduction in what the exchange rate, right? So in an uptrend anywhere beneath this 50%, then I start to think of what a possible what push on the upside again. Not from this region though, but from here. Look at it clearly. From here, from the 50% all the way into the 78.6, right? I start to think of what a pushback on the upside, right? So once we cross that 50% barrier, then I start looking closely in the market. But how do you identify if the market is rejecting on the 50%, on the 61, or on the 78, right? You have to start observing price action. How do you observe price action? Here we totally broke through what the 50% with a strong candle. So outrightly you can see that what the 50% level didn't even try holding as a retracement level, right? And then subsequently we were trading what a little bit beneath the 50 and the 61.8, broke through that 61.8, and then now we're stuck in what in between the 61.8 and then the 78.6. You must understand that Fibonacci retracement will not be a pinpoint thing tapping exactly on 61.8 and then go up, or tap exactly on 70. It will trade within those regions, right? It is up to you, the trader, to understand price action to catch the move in continuity, right? You calculate the number of pips. Number of pips the rectangular box should be. No, I don't calculate the number of pips the rectangular box should be, right? It's a range. You have to determine within relevant ranges, right, as a trader, how much you're willing to risk, and then use that rectangular shape to determine that, right? If I watch this to here, there's about 35 pips or something like that, right? So here, then I know that what the market is beginning to reject between what the 61.8 and the 78.6 based on what is going on here, right? How would you know if the move is going to be explosive or choppy? By waiting. the only way to know is by waiting, right? How else would you want to know if you don't wait, right? You wait, the candle close, you wait, another candle close. You get to know that. Don't worry, when we get into the candlestick formations, that would be even more clearer, right? So I wait a lot. I spend about 90% of my trading time just waiting and waiting, and then a few times, which is like the 10%, actually trading, right? So 90% of the time, I mark up my charts, then I have to wait and relax and see how things unfold, and then 10% of the time, I just come into it, execute when all conditions align, right? So here you can see what reject here, 4 hour, 8, 12, 16, 20, 24, right? Spend 24 hours within this range alone. Tells what price is what refusing to trade any further lower, right? And then what do? You want to find an entry after a strong bullish confirmation, which you learn later on. Put your stop loss beneath that range, right? Could be somewhere here or beneath the wick, right? Some few pips beneath the wick. And then what happens? The trade runs outrightly in your direction. That's how the setup would have been like. And then upon running, where does it hit? It hits your fib extension of what? Negative 27, right? So Fibonacci doesn't only work with the retracement, the extensions also do work, right? As in the market pushes up, it has retraced, now it's continuing the move. This is the equal highs. If you break this equal high, it's an extension in the move. Where does that extension possibly end? That's why we have what fib extension of negative 27. And then we have even negative 61.8, but I recently deleted my negative 61.8, right? But sometimes you can have a market trading into the extending past the negative 27 and then running into the negative 61.8. So that is the meaning you should make out of Fibonacci extensions. Let me take that once again. So this is a swing point. There's a retracement. Once the retracement hits here, it's making what equal highs. If it trades above this high here, then it's what an extension in the market movement, right? And then Fibonacci extension is also a good measure to see where the market could possibly what stop and what reverse or something. So you can see that this market taps exactly on what the negative 27, and then abruptly there's a big what drop, right? So here could have been what a good point to establish as your take profit, right? As your take profit level. If you had caught this move here with your stop loss beneath, then a good way to set your target, right? A good way to set your target in this kind of a move would be first putting your take profit one on the highs right here, because you don't know if the market is going to make what equal highs and then reverse down, right? And then your take profit two will be this fib extension, means that if we break this equal high, most likely we are going to run into this Fibonacci extension before possibly what any drop, right? So once you have your setup like this, you don't panic in taking was it profit too early, right? You once you're risking properly as well, right? People will panic out of positions when they are risking above what their accounts can possibly handle, right? You realize that for the most part, people that trade 0.01, 0.02, they're able to hold trades so long, and they are not affected by pullbacks, blah blah blah, and then whatever the market is doing. Why? Because they know that 0.01 or 0.02 won't hit them. Or once somebody puts on 0.5 one lot on a small account, a little blip, then they panic and they act irrational. So that is why I always emphasize on risk management. If you want to make a lot of money, then go find a lot of capital, but you cannot disrespect risk management just because your capital is small or whatever it is, right? So yeah, That is it with how Fibonacci would have worked with this setup. But we hit here, abruptly we start dropping, right? Upon starting to drop, nothing has changed. It's a rinse and repeat thing we're doing here, right? So here was what our initial swing point, and then we retraced. Let me use a different color for the retracement. And then we retraced, right? And then we created what? A new swing point. And then we start to push down again. The rule hasn't changed. What should you do? Quickly pick what your Fibonacci measure from what? This swing point to that swing point, and then you're interested in what? The discounted pricing area, which is what anywhere beneath what this 50%, and then the 78.6, right? So what do you do? Usually you see that once I'm expecting a retracement, I could stretch a whole rectangle in between the 50% and then the was it 78.6, and then what do I do next? I can decide to take the Fibonacci off, because by then I know exactly what I'm looking for in this region, right? But if you don't have the experience yet, you could decide to leave it there as well, right? And then just monitor what will be going on in those range. But subsequently, what can we observe here? We run down here with a spike. Look, don't get confused yet and wonder how am I going to get an entry here, or all I see, because you don't have the idea of the candlestick formations yet, right? But if you have the idea, if you tend to learn that, which I said we would learn probably today or tomorrow, then once the market is just doing this kind of thing, you're not in any rush to say, okay, the market just tapped into this 1.8, let me start buying, or it just tapped into this, let me start selling, right? You realize that in this kind of scenario, I wouldn't take any action here, but I'll start observing the market from here, right? From this range, right? Or even if it pushes up, then you know how I always would wait for a retest. If that level leaves me again, wait for a retest. Once a particular range proves as what that retracement level, I want to find an entry within that range, put my stop loss beneath that range, and then see how the market is gonna react, right? So here you can see what clearly 78.6 was that area that was holding off as what a retracement for this swing point before a continuation of the upside. But there's something tricky here, right? There's something tricky in this setup. That's why I usually like to use this setup to teach. So if you watch this chart, right, we're predominantly in a very huge uptrend, right? Starting all the way from the very bottom here. Higher, high, high, low formations all the way to this point. And we get to this point, maybe what? Push up, retracement, another push up, right? So you're following that same systematic movement. A push up retracement, you're expecting what? Your fib extension to be hit, which is what? Take profit from here to here, right? Which is what gonna continue that trend movement. But what happens? We get to this point and then we totally stop. But why did we stop here? All right. One of the characteristics of a change in trend in the market is the head and shoulder pattern, right? I don't think I am the one that's supposed to teach anybody here what the head and shoulder is. So we have what we call the left shoulder, the head, and the right shoulder. They are patterns that anytime a market, let's say, it's from a down uptrend and it wants to change, these are the kind of patterns that it may want to form at the very pinnacle of the market before what it takes that market down, right? So you have to know that as well. So if it's in the downtrend, then it may want to use the inverse head and shoulder, where like the market is trading downwards, gets to a point, it makes what the left shoulder, the head, the right shoulder, and then it breaks that level and then goes on the upside, right? So upon running all the way up like that, and then getting to this point, pushing up, pushing down, retracing, continuing, fine. Indeed, I would expect this market to trade up onto this range, right? But I would also be very vigilant on what happens here as well, right? I would also, based on what I just told you, and I'll be vigilant on what could happen in that range. So there you see that I have what a horizontal ray there to see how the market is going to trade when it gets to this point. Is it going to form that head and shoulder thing and then drop down or something like that, right? So initially, my fib extension is what, from here to here, expecting a retracement here to catch the market on the upside, right? And if you watch this one too, here's also what a new swing point, because we started from what, by this time in a downtrend, right? From 100 to a 0, right? And then this could be what, a retracement of this 100 to 0 for a push down, right? Do you see the whole scenario? This one was what, 100 to 0, and then we made what, a retracement to the 70, and then expected a push up. But here to here is also what, 100 to 0. We retrace into, let me use a red one. We retrace into this, tapped exactly onto this head and shoulder level, and then what, a push down, right? So these are the kind of scenarios that will make me take a hedged position. So if you see that I have buy at the very top and I have sell at the very top, sometimes because the market is giving me conflicting issues or conflicting scenarios, I don't know if we're going to break a previous high and continue up, or I don't know if we're going to trade downward. So I watch the whole scenario around it and then come in at the right time and then find what a hedged position. So this is how things will look like if I have a trade like this. Let me show you guys how the whole setup would look like. But it takes a whole lot of experience and skill to do that. All right, it doesn't just come randomly like that. You would need a lot of practice. So you'd see that I'd have what, a long from here, stop loss beneath the range, expect what, take profit somewhere here though, right? So let's say in this scenario I have what, one lot running there, right? And then from here to here is about what, let's say almost 100 pips hit already. That's a lot of money if you have one lot, right? It gets to this point again, I'll be observing what price action within this range. More so, I have what, that inverse Fibonacci also working. And then let me take the previous Fibonacci out so that you see things clearly. So clearly you can see that one. Again, with this one here, we are retracing in the between the 61.8 and the 78.6, right? Then if you tend to read price action here, this one is what, a doji, a hanging man, a bearish engulfing candle, clearly defined reason for an entry, for a short. But already we have an entry for a long here. So what do? That's what we do, hedged trading, right? So even though I have a long position from the down there, I'll still what, once I have the confirmation, take a shot. I'll still take a shot here, put my stop loss right beneath the range, and then with that short position, where is the fib extension going to be? Can you see the fib extension level here? Because this is the retracement, a push down, retracement, fib extension. Unlike this one, it was a push up, retracement, and then the fib extension was here. But this one is what, a push down, a retracement, and then a fib extension here, right? So fine, we have a long position from the down, but again we have what, a short position from the top, right? So this is how the setup would clearly look like if we're using the replay tool. If we're using the replay to this, how the setup would look like. Me finding a long here, right? It runs into our range, but it's also giving us what, signs of weakness within here. But we have what, one lot here already, right? We have one lot, and then that one lot is already running 100 pips. And then we're seeing if it's going to break this level or go up. But here it pushes down, gives us a strong confirmation for a bearish presence, right? What can you do now? You can decide to close partial profit from the one lot, which is what, closing 0.5 off, right? Close 0.5 off, or like close 60 or 70%, whatever you want to do. It's your choice, though, but you close partial profit off. That way, that money is already banked. Then you want to what, take on the risk of what, shorting here with a new setup. Here becomes a new setup, right? So here I could decide to also risk what, one lot here again, because it's a new trading setup, right? If I put on one lot here, still my stop loss is just here, right? So there are two things that can happen here. What are the two things? Number one, this trade can what, totally disrespect me, break out, and take me out, me losing whatever value that one lot will be, right? But the other end of it is that what, if I lost that trade, that 0.5 lot remaining here would have at least covered some portion of that loss there. And indeed, if the trade invalidates me by closing here, then it has potential of what, going further up. If it goes further up, that one lot that I lost here could what, made back from that 0.5 that I'm still holding, right? That 0.5 that I'm still holding could make back for that one lot. But let's say all things being equal, that scenario actually plays out, right? So indeed, I have the 0.5 here, but I put on a new one lot there. Remember to put your microphone on mute. But I put a new one lot there. My stop loss is right above the range, and then let's see what happens. The market puts me in profit. What do I do? Already, this position is protected. This position is also what, quickly protected, right? So now there's nothing like what, a losing side. Now I have what, one lot here in profit, 0.5 in profit, right? So all that can happen is that either the market can decide to retrace from here, whatever it wants to push out, or indeed what, 0.5 running here, 1 running here, and then analyze on what the full potential of the market. I could decide what, I'm not going to close this just because this is coming close, so I'm not going to close the one at just because it's coming. I'll just leave the market to do the hard work. If it closes me, it will close me at break even. More so, remember that we've already taken some partial profit from here already, right? So push down, push up again, consolidate, does its own thing, takes us out at break even, right? So now we've lost some money here though, right? Or we've left some money on the table here, but we made up for that money on the table from this region, right? And then if we're supposed to continue holding this trade, then obviously what, we hit take profit for that one as well, and then we made what, it becomes what, a win-win scenario on both sides. But it takes what, skills to do that, right? It takes skills. Quite recently, you've seen that I showed you some hedge position. I think that one was also Aussie dollar, Canadian dollar, right? But that is the reasoning behind if you see that I have a short position and a long position on a single pair. That is the reason. I'm sure most of you have seen a couple of screenshots from me showing that, but you don't understand why I do that, or is it just because I'm showing that I can catch tops and bottoms just anyhow? What's the real idea behind? But this clearly defines the real idea behind it. Somebody says he's going to miss the session. We'll see what we'll do about that. So basically, talking about Fibonacci, the rule of thumb doesn't change. Once we hit that extension, start to retrace again, what do? Plot your fib level again, right? What do you see this market doing? It's still going to be observing how it plays around after the 50% retracement, looking into the 50 and the 78, right? You can see what reflecting just around what between the 50 61.8, rejected back in this region, and then what there was a setup. That setup, your take profit could have potentially been here. That's what I'm saying. What that's why you always have to have two take profit levels, right? Which is what the initial lows and then the fib extension. Just like I was telling you here, that if I was taking a trade here for a long, my take profit would have been here, and then the fib what extension. Because sometimes the market can hit this level and then decide what reverse, just like it did here. If you took a short here, it just tapped into this level. You would have expected what it to come to this extension, but it didn't. And then what happened? It reversed all the way back up, right? Just confusing us if we're now in an uptrend or a downtrend. It's just how the market works, right? You can't blame the market. That's why I use confluence in my trading. That's why I have psychological level. That's why I have traditional support resistance level. That's why I have the trend line. That's why I have the Fibonacci. That's why I can read into candlestick formations. So in this kind of scenario, you can see what we had, some form of what, a double bottom, push down. If we record this trade, we would have hit this level here, right? You'd have expected a continuation down, but here we start to reject this region, right? And then you can see some clear candlestick confirmations for a long, right? There is a clear confirmation for a long from this region, right? And then this is also a clear scenario that you could apply the same hedged strategy if you're confused, right? Even if you're confused, you could have taken that same. So here will be our short, expecting the market to make that extension to this point. But we hit this level, we start to reject, we start to make what, an effort to push up. You're confused. With this market change direction and then go up, it provides you with a hedged long setup. You can take that hedged long setup while you keep your short. Expect your anticipated profit to be here, and then you want to expect the next profit to go the next zone here, right? So here's the first high, here's the second high, right? And obviously you can see that what we tapped into this profit, smashed through here, and then what run all the way up into these regions. So you always have to look at the market like a storyline, right? Where it's just following what patterns, just following continuous structures, following, it doesn't have to be too difficult to just spot setups in the market, right? Don't just apply because Kojo taught you trend line, you're always drawing trend line left and right like that, right? And then again, even with this kind of scenario, I think but the trend line also gives you the basis, right? With this scenario, you can see clearly what the trend line would have done, right? So you can see that I didn't even apply just trend line here, but I applied Fibonacci, and then it came in confluence with the trend line as well, right? That is what I call a strong setup scenario, right? Where we have the trend line scenario playing out. What do? We put a horizontal ray above that breakout candle. We want to see how the market react above this range, and then we also can clearly see how Fibonacci is reacting in this setup, right? 61.8 rejection. Then you can see what evening star formation, which is what I would have based on to take a shot in this region. Put my stop loss right above this range, and then you would have been able to make as much as what, over 90 pips on this trade, 95 pips, right? We hit this level, start to reject from these lows again, pull back in. I see a bullish engulfing. I would want to take the chance to go a hedge long by closing a little bit of this profit, maybe half of it or 60 or 70% of it. Take a new long here, put my stop below beneath. If the market takes me out, then this one is going to continue running. If it doesn't take me out and run up, then I may be in for a big surprise, right? So in this scenario, what do we see? It doesn't take me out, it runs all the way up, it closes the small position I left running here. I break even, but this one continues to run. It fulfills the take profit 2 target, money made, right? So you can see the confluence for this setup would have been from a third touch of the trend line and then what, the Fibonacci as well, right? So you have to learn how to use them. You have to practice, backtest, and then once you have a scenario like this, you can easily take a screenshot, right, and then learn from it, right? This is what you do. Take a screenshot, you save it somewhere in your folder, whatever you want to do, right? Every trade setup you're taking, you have to learn from it. I did that a lot, right? I did that a lot. I had a huge catalog of trade setup. Then I'm asking myself, okay, this scenario is from a trend line scenario. 1, 2, 3. This was my confirmations for a short. We hit this level, I would have expected we break down. It becomes your learning tool, right? Here we doesn't break down, we push up. What have given me the indication to find long here? You read into the kinds of information, you measure what possible stop levels, how huge it is. If the stop level is extremely huge, you want to avoid that pair or avoid that setup. If the stop loss level is relatively okay, you take that chance, you hold the trade, and so on and so forth, right? So back here again, then you could have even had another entry, right? What would have been that entry? It would have just basically been the market reacting on my psychological level, right? Because after we spiked all the way up from here, the next point of interest was we tapping into it, 96.50. Tapped exactly into it, pushed down, consolidated within that 96.50 for a long time, right? All these rejections here are giving me signs that what the market is failing to trade any further high. Once I find my confirmation entry within this range with respect to candlestick formations, I wouldn't mind taking a chance here, shorting this market, putting my stop loss right above this range to see how things play out. As far as I'm risking 2%, then I don't mind how the market plays out once I have a valid setup to trade this thing, right? Here you wouldn't have maybe trend line playing out, Fibonacci, whatever it is, but my confidence would have clearly only come from what the psychological level with respect to how the market had been reacting there for a long time, right? So sometimes I can take a trade and then you wouldn't even understand the reasoning behind that trade, but it's just me taking a solid risk based on what I see, right? So always remember to trade what you see, not what you think, right? Says, how do you draw your weekly resistance? We talked about this clearly yesterday, right? Except of course you're not in yesterday's session. Who's this? Topi Emmanuel. Were you in yesterday's session? Where is this person? This person from? So apart from the market also using that left shoulder, head, right shoulder to change trend, another scenario it uses to change trend is a double top, right? So the market could push up for a top, push down, equal highs, right? And then change the trend. Or it could use a lower high where it will push up, the next high wouldn't reach this level, possibly maybe 50% C2 178 retracement, and then would push down before the whole trend will change, right? So this is how usually trends change in the market. There are three scenarios: head and shoulder for the trend change, double top, which is equal high for the trend change, or lower high for the trend change, right? Always have that in mind. These three ways are the only ways in which the market can possibly change trend, right? So all the time when you mark up your chart, you're watching out for this. Number one is what? The head and shoulder for the continuation down. Number two is what? That double top for continuation down. Or number three is what? The lower high for continuation what? Down, right? So here, even though I would have expected what these head and shoulder to have been what a catalyst for a change in the trend down, but you can see outrightly that we broke all the way up on the upside. Coming back into this, I'd be interested in how the market plays around this region, because I know that what we've come to the pinnacle point in the trend, and then we could what just changing trend. But here you can see that it would have been a very tedious region to find a trade setup on because of what the choppy nature of how it was. But nonetheless, once you understand market structure, you understand trend change characteristics or behavior of the market before it changes trend, you don't get tired watching this. You actually would have that patience for it, let it do all it wants to do. The right time when you find what a confluence that aligns with what you'd have done depending on what you want to do, then you take a setup for a short, understanding that indeed we're coming to it. So here, left shoulder, head, right shoulder, it didn't work. You run up, push down, double top. You want to see how here also holds, right? Indeed, we have what this big manipulative spike here, right? But it's still in line with this one here, pushes right back into it. You don't always have the market acting exceptionally perfect with respect to the highs and the lows. There's this little bit of manipulative spike here, but I'll still be interested in watching how the market plays around this region. Runs back in, push up, blah blah blah. I can easily find what a setup entry here before that massive drip on the downside, right? You can see what now if this drip happened for some reason, coincidentally, where do we tap this weekly resistance level again, right? And then that would have been recapitalizing on what about 220 pips if we took that trade setup. But upon tapping into it, what happens? We tap, we push quickly up, right? Most people will start jumping in here for a long trying to catch the market up. But if I don't catch the market within this region and then it pushes up, right? Best I'll do is what? Wait for a second retest. And what do? You can see if you've watched my Instagram live several times, I talk about that second retest, right? It pushes down, push up, comes back to retest before that major move, right? So I'll be interested if I miss the initial entry. If I took the initial entry here, it's still within this range. So even if the market pulls back down on me, my stop loss is obviously beneath this wick. So if my stop loss is here, I wouldn't have been caught out with this one here, right? I'll still be in a drawdown though, but eventually I come back on top. So sometimes we take position and then we're in a drawdown and then you're confused. But once you understand price action, you don't start panicking with those drawdowns, right? Sometimes you may get smashed, fine, but that's just what happens sometimes. Like the trade we took on. So this is Aussie dollar card. We'll come back to it. The trade we took on Euro Japanese yen on Friday, right? This was the scenario. A push down, push up. With this candle, I thought we could just basically hold here and then run back up and then possibly be improved. But what happens? It clearly what took us out. It's just how the market works. So it didn't work. Why was I looking for a long here? I was looking for a long here based on what this region and how the lows were reacting within this region here, right? Can you see that? This was the last low. It was just what a wick to take our liquidity as I expected. We ran back up, found an entry here, right? people that got into this trade very early wouldn't have taken a stop loss because we ran about 22, 23 pips, where I would advise I usually put a stop loss to a break even. So to tell you the truth, personally on my account, I didn't take a stop loss too because my entry was here. We ran back up 24 or 25 pips on stop loss quickly at break even. So that next 4-hour candle, which smashed to just took me out. And then I was still very observant, watching how we reacted. Usually you'd see that once we're turning bearish, I would say, guys, close this position. But in this trade, I didn't say close the position, right? Usually, for anybody that was in the VIP group, usually realize that if the market is reversing against me, sometimes I do come in and say, let's close the position for a while. But this trade setup, I said, I didn't mention that. That was because of what? A similar scenario that I've seen over and over, where the market will run up, come back to take another liquidity, and then run back up again. But this time, it didn't work, So that's what I was talking about when you look at Aussie dollar card from here, right? It's the same scenario where we run up, push down again, you get scared, you run out of the position, then what happens? The big move actually does come. So yeah, just watch out for those kind of formations as well, right? Again, after running up into these regions, what happened? You have to consider Fibonacci in our dealings, right? So this is the swing point. What retracement level did we hit? Here is not what a discounted price again, but rather a premium price, because what is an increase in what the prices, it's not a decrease, right? So I'll be watching between the 78.6 and 50%. If you see how the market was reject either on the 50% level on the 61.8 or here, you can see clearly we're rejecting between the 78.6 and then the 60%, right? Once you have a candlestick confirmation that aligns with your short entry, what do? You take the risk, risking reasonably, you hold a trade, and then what happens? It smashes all the way, surpassing even the fib extension, right? You can see that this was the fib extension. So trade, retracement, entry, fib extension, tapped, and even went further down. So here, if we had a fib extension of negative 61.8, then that would have been this one here. But I told you guys that I took off the 61.8, negative 61.8, for no reason, actually, for no apparent reason. But I just decided to take it out, right? But you can put it there if you want. So you can see how Fibonacci works, right? Let's see this chart. I think that's the end of it, right? So that is how you apply Fibonacci trend line. So far, any question? So far, any question with the trend line and then with the Fibonacci as confluence? Any doubt, any question, any clarity, anything you want me to go over? Is the right time to do that. Euro GBP. What has Euro GBP done? Is Euro GBP taking out the last low? Obviously, we want to see how the market will react on certain lows like this one here before we take a decision I would have actually expected that once we were in that kind of a wedge formations, we would have traded, rejected within this region, traded up back into this region. But clearly, the market has a different opinion, and then I cannot fight with the decision of the market. So yeah, that is basically with UAGBP. Even with this, there's a clear Fibonacci retracement, rejecting here, easily find a short back. What could we do? We could possibly run into this fib extension. So Fibonacci is not really it's just a tool to guide you. It's a tool to give you clarity, right? It is not like a basis for jumping in on a trade, right? But it's just a tool to give you a possible clarity of what is really going on in the market, right? It's just a tool to give you that guidance, that confluence, right? So anytime you're looking at Fibonacci, think about it as well. A swing point, a retracement. How can Fibonacci help you to find a retracement? Another swing point, a retracement. How can the Fibonacci help you? Swing point here, obviously, we don't make any major retracement unless you're looking at a 23, which we don't use, right? And then a big push. So all the time, Fibonacci is just a basis of guidance to function of a trend, right? That is the job of Fibonacci. It's just giving you like a prime point to jump in on a trend if you miss the initial move, right? That's why I was using that drawing tool here, where I draw initial move, make a retracement. So here I missed this move. How can I join this move? Unless I plot my Fibonacci and potentially see how it reacts in any of these regions. Let's say here we come into this 61.878.6, and then I have to see price action within this range, find an entry and move. Let's say another person missed this move. How can they find an entry here, right, to continue in this market trend? That person also can now apply two concepts here. Number one is the trend line, right? 0.1, 0.2, and then expect 0.3. As far as they are also expecting 0.3, as the market starts to make a little bit of retracement, maybe 20%, they can also plot their Fibonacci, even a small confluence, to see how the market is going to play out if it hits their prime range, which is the third touch of the trend line, plus the fib level established in that range, right? So if that market trades all the way down, let's say it breaks, they remember the breakout rule, plot their horizontal ray, see how the market reacts. It doesn't close beneath it. They find an entry based on the confirmation. You can see how that trade runs with their extension, and what is basically a rinse and repeat. So Fibonacci, like I'm saying, helps you to find an entry in the continuation of an established trend, right? So that's what you should have in mind all the time. But it's not necessarily that thing that will tell you that jump in here, buy here, or sell here, right? But it just gives you a good region that would be prime for Yes, it's a confluence that the market will continue in the same direction. That's a good way to put it, right? It's a confluence to determine that the market will continue in the same direction. If it doesn't, then it's a total reversal. Do you get it? So that's how you think about Fibonacci. When I take the scenario of the AUD card that I showed you, which I said happened some months back, or it also had a perfect um, scenario going on here, right? If you look at this, just the way I was showing you, point 0.1, point 2, point 3, that is the third touch, right? What can we do if we plot our Fibonacci retracement here? You can see we are clearly rejecting on what the 78.6, which is also a confluence for a continuation in the same direction. And then this trade was one that spectacularly hits the fib extension of negative 61, not the 27, right? If I put the 61.8 there, you see that it was what this market tapped on. This is the negative 61. What is it? I think I deleted it. Okay, this is it. Can you see that? Can you see that? That was where the market hit, right? So this region here is a negative 61.8. So here is the 27, then here's the 61. So here run all the way, smash through the previous resistance, smash through the fib extension, and runs into the negative 61.8 extension, right? But I decided to just delete that one for no apparent reason, like I told you guys. Yeah. So that's just how that setup works. So Fibonacci, like I've told you, always gives you that clarity to consider what a continuation of a trend in the same direction. But the market is very random, right? So always, as a trader, you always want to make sure that what the market is playing according to your script. If it doesn't play according to your script, you don't want to force any trade on your neck, right? That's something that takes somewhat a good amount of discipline to attain, but I believe that anybody can do that, right? So I don't take trade just because I have to trade, just because I have to make some money or whatever it is, right? I only trade when things align in my favor, right? I have all the patience in the world to wait and wait and wait until my setup is clearly defined. That way, if I make a loss, I have a reason to understand that loss. But if you don't understand your setup and then you just jump into anything you see, like the way I was telling you with this one, I have a good reason to understand why I took a loss on this trade or why this trade didn't work out, right? So if you ask me, that was how I was able to explain the trade entry and then the setup to you guys. But what if you just decide to jump in and then you don't have any reason behind it? You didn't grow or you didn't learn. The same scenario was for USD JPY as well, right? I was also watching the same region for it. It was a little bit tricky with USD JPY because it moved in our direction, pushed back down, spiked down against us, took us out here because my stop loss was beneath here, and then ran back up into it and then pushed us. So you can see what it's just being manipulative here, right? It's not giving us that straight into profit kind of a trade. So sometimes it's just how the market works. You have to deal with it, right? You have nothing to do than to just deal with it. But yeah, that was a trade setup, right? I was looking at here as well. Support, we pushed up, did whatever I wanted to do, ran back into that support, pushed up, did whatever we want to do, run back into this support. Here's where people that have been tricked, but I didn't look at taking the short along here because I knew here wasn't the level, right? We could have pushed a little bit, and then indeed we pushed a little bit low. Watch price action there, saw my clear confirmation. I actually anticipated this thing to run up, but indeed we pushed down again, took us out manipulatively, and then now we're seeing how we're building up. So I don't know what's going to happen from next week. We may just run continuing up, but that is the setup if you look at things clearly from what a bigger picture angle, right? So since you're learning from here, if you're in any of the groups, once a trade setup is drawn, I expect if you look here, right, this inner trend line as well, right, you can see how point one there, point two here, and then point three run all the way down, right? And then point three is in confluence with what? Again, Fibonacci. Push down, pushes up, tap into the 61.8, closes with a tweezer top, which you learn, and then runs into a fib extension, smashes through it. Over 110 pips, 20 pips trade setup. Right. Very easy, straightforward. Yeah, the group for the levels, I'll send you guys the link. Don't worry. It's nothing to worry about. It probably skipped me yesterday. You clear your chart after each analysis. After a particular setup plays out, I just clear it. But I don't clear everything. I clear the particular zone that had me watching closely, right? I only clear that zone that had me, like, or if I have to readjust, right? Like this one, like this, I have to readjust this trend line from that point to here now, now holding as what, 0.2, right? And then here was the lows I was looking at. It didn't play out, so I have to take out this low. You get it? So that's what I do, just clearing some few irrelevant lines and then putting the new perspective on board, right? So in a scenario like this, I'd be interested in seeing if gold can come and make what, sort of a double bottom, which will tap into this trend line, maybe manipulative spike with a breakout candle. If we close above it, then I'll find what, a long up, possibly into this range again, right? Or if we don't do that, then I see how we continuously trade up. If we trade up, I'll also be interested in what, the Fibonacci retracement, to see if we're going to what, reject them, possibly what, continue down. So all the time as a trader, you should have what, different bias, different perspective, right? But in all this, what will give you the confirmation to take the trade is what we'll discuss, like I said, tomorrow, right? I want us to do that tomorrow, talking about the candlestick confirmations and then the correlation and cross-referencing and then the fundamentals and the weekly ranges, right? Weekly reversals and stuff like that. So up to this point, is everyone clear on what we are doing? Somebody says, is there a specific time that news occurs? There's no specific time. The market can move at any time it wants. Unless you're day trading, then you may want to specialize in time frames, but or time zones. I mean, but as a swing trader, there's no time. Volatility can set in at any time at all. Right? If you're a day trader and then you're watching, let's say the pound pairs. If you're a day trader and you're watching the pound pairs, you may want to watch them in the landing session, right? In the landing session. But if you're a swing trader, whether you're watching the pound pair, euro pairs, you have to just follow your markup, right? So I used to extensively or actively day trade the pound pairs. Well, always be up before 5 a.m. Watch the market, see how things play out, and then jump into the market or something like that. There's something I'll show you guys tomorrow, right? How to even catch. That's it. That's after we do the candlestick confirmations too, right? It will go a long way to help you in catching like very, very, very solid trade setups with ease, right? With extreme ease, and they're not even adding anything, no indicator, no nothing to your charts. Really, really easy just to spot good moves on the market. In confluence with everything we've done here, that is also more like an added confirmation, right? That comes on board as an added confirmation. So yeah, as far as we're concerned, we built up strong knowledge by far with respect to looking into the top down. I'll send you guys a link after this session, right? So that you see how I just draw my levels, right? We've looked into it, the top down, understanding 1,000 pip, everything that has to do with it, why I choose the levels, and then we look into how I choose gold, US30, which is different from the top down, and then we looked at what market structure, understanding highs and lows, double top, double bottom, triple top, triple bottom, and how they affect trend change. And then we've looked at the trend line, and then we've seen the power of what the third touch, and then how to trade the third touch even if the market is trying to trick us, right? Even with a scenario like this, the third touch will play out, right? It will come off very strange to you, but I would consider this the breakout candle, and then see how we run back down, right? As if you're watching on the 8 hour. As I said, the time frame you draw, the time frame you should maintain. If you draw this on the 4 hour, obviously it got taken out. We've looked at how powerful the third touch is, the rule of finding entry on the third touch. We've seen how Fibonacci can also act as a strong basis for giving us confidence to determine trend continuity, right? Even if you look at gold, this huge setup here, pull back into this, run down, pushes up, but I still measure Fibonacci from here. So it's always like a very easy tool to give you a good basis of what possible entry or possible reversal, right? It is not the tool that will just be the decider to jump in for a short or a long, but it just gives you a good basis to understand what is a good point of entry in the market. So now we've looked at Fib and how to use Fib extensively, right? And then they are all now coming up together. And the last thing we'll look at is the candlestick confirmation, where like now everything has to add up. That okay, I've drawn my trend line, the Fibonacci retraced, blah blah blah. What should I see before I take a long, or what should I see before I take a short? Should I just jump in? No, you don't just jump in. So I'll show you what I call the risk entry and then the confirmation entry, right? So I have two entry criteria that I specifically follow. Sometimes I take the risk entry, but most times, right, about 90% of the time, I take the confirmation entries. So I'll show you all that tomorrow. Do what to always backtest whatever I show you. Go into the chart, try your hands on the trend lines, try your hands on the Fibonacci, and then anytime you're reading anything, read it in line with what I've taught you, not outside. Don't start finding concepts that has nothing to do with this one, where you're going to find some Elliott wave or some, I don't know, things that has nothing to do with what we're doing here. GAN, or adding some indicators. You're going to bring some, moving average, convergence, divergence. You're going to bring volume, RSI. If they played out, I would have had them there, right? If they made sense with the chart, I would have added them there. So once you've seen that they're not there, then you don't. Well, you could be innovative by yourself, though, but that's to you. I don't really prevent people from being explorative, trying new things and then seeing what works for them. But as far as you, I'm concerned with what you are learning here, and I don't have moving averages here. I don't have was it MACD. I don't have RSI. Right, I'm just using pure technical analysis that you're seeing here. So, do you have any link or information to line? Link? What do you mean by link? So when you go through the webinar, like as far as with where we've even been able to come to, right, with where we've reached so far in this session, right, you shouldn't even be thinking the way you are thinking, right? With where we have got to, you shouldn't even be thinking the way you are thinking, as in because things should start being clear to you now, right? And then once things are clear to you, what does it mean? It means that you're thinking of what? Longevity. And what do I mean by longevity? Right? If you're trading, you didn't pay for this course just because you had some money to spare. You paid for it because you want to have my perspective of how I trade, and then how it's going to help you to build a long-lasting, self-sustainable career in trading or whatever you want to do with it, and then would make some good progress from it, right? So start taking out that dependency mentality. But my signals could only serve as a basis for you to judge reasoning into what you've learned from me, because whatever I've taught you is the same thing I will use to find trades. So if you've learned, now you understand. Initially, if you didn't learn from me, when I say buy this, sell this, you can never reason into it, right? Even if you did, you may be applying a concept from whatever you know from somewhere. But now, if you see that I'm saying what Euro JPY buy, and then we are standing around these regions, right? You could easily watch. Is it that Kojo is watching these levels, or is it that he's watching the third touch of the trend line, or you think, or is he watching some Fibonacci retracement? You think, right? You think, and then you consider, and then things will start what becoming clear to you, and then you watch how that trade plays out. It plays out It also helps you to establish your confidence, and then on and on, you have your own basis of what doing things on your own, right? Remember that this is not like the only um, training session I've organized, right? With this, your question, it sounds as if this is the first time I'm ever teaching this, and anybody that learned from me do trade by themselves, and then for the most part, most of them even catch trade setups that um, I miss, right? I have so many students catching trade, wild trade setups. They send me screenshots, they post it in some communities on their Instagram, tag me, and then me that I even taught them, I even miss those moves sometimes. So yeah, eliminate that dependency thoughts. Should we consider a point to be theta if it comes very close? or should look or should you no, don't consider a theta if it comes close. Let it tap into it, right? It may come like let it touch. Just let it touch, right? There's no variations here, right? I'm not gonna sugarcoat it and say if it comes a little closer you consider blah blah blah. Right? Solidly just let it run into it, tap into it or run through it, right? Because there are times where I've seen some before, right? Let me show you a scenario. Like let's say something like this. The market will run up here and wouldn't really tap into it and then start coming down. But if you are so used to okay, it came close to it, so let me start finding a short because Kojo said sometimes it may come close. There are times I've seen something like this. It pushes down a bit and actually comes back later to tap into it before coming down. In that way, you'll be stuck in this trade or may easily take a loss before the remove. Okay, so just um, just follow the script and let it touch. Do I have any link on the Fibonacci? No, I don't have any link because I don't know why I should have a link on the Fibonacci. Right, the levels is just what because you may have um, a different perspective or a different bias, right? Like initially told you, it's a subjective reason into the market. But at the end of the day, once everyone is applying the concept, we may not have exact levels, but would have one very similar level. Today, somebody sent me just their markup on is it New Zealand US dollar New Zealand card, right? It missed mine by I think 5 pips or something like that. Is it? I don't know if it's 50 pips or 5 pips. Probably 5 pips, right? But that's what could happen with respect to variations, right? But that is just how I look at the market. So if you want to look or plot your levels exactly like mine, right? That's why I have provided those resources there for you. But it doesn't mean that you cannot come up with your levels, right, based on the concept, right? So I developed my levels based on the concept, but anybody else can also pick their levels that the market will align to and then they'll be comfortable using. But if you want to use mine just because maybe you may want to have a little bit of confidence in mine than yours, or you want to look at mine and learn and improve yours, or whatever it is, then those resources are available there for your use, right? Because sometimes I even adjust them again, right? If you look at a trade like Aussie dollar card, I had a different markup. This is FXCM. If I open KUD card on I think Rwanda or something like that. Right, so you see here as what 9600. But if you watch the FXCM, Then it's what 96.50. And then which one aligns better? Here's what sort of resistance. So I quickly readjusted to get used to it. The Aussie dollar card one for the FXEM rather than what the Rwanda. You get based on how the market chose to be reacting around those levels than it did here. You get meanwhile I applied the same concept of that level. That's what I'm saying. What it becomes a little bit subjective with respect to finding that exact thing. So I taught you that and then I'm supporting you with those documents. So if you want to do things like mine, because I told you that entry criteria is not based on okay the market has hit this level so Kojo is going to find a short, right? It's just a basis for me to see how potentially the market could be reacting around those regions in confluence with what my other factors, which could be what the Fibonacci, could be the trend line, could be what the candlestick formations or any other concepts that may come in play, right? So yeah, this is a clear example to see the difference between what I do, right? Yeah. So I think you guys have exhausted your question. I believe today's session is clear enough. We've understood um, things are gradually coming up. Things are gradually coming. So tomorrow is going to be the most in-depth one, right? Tomorrow there's so much to talk about. Tomorrow, and then tomorrow we'll actually crown it, right? Everybody says they're feeling sleepy. So yeah, we're ending it here, though, right? I believe it's an eye opener, and yeah, practice makes perfection, right? The only way, the only way you can survive here is practice. The only way you can survive here is practice. It's through practice. If you don't practice, you can never perfect this. But if you do practice, things will start really picking up, right? So without much ado, we're going to end here. Tomorrow, I communicated time as usual, but I'm certain that we'll do it um, earlier, right? It could be 5 or if it is 6, whatever it is, I would make sure to communicate way way ahead of time, right? And yeah, there's so much to talk about. If this is an eye opener, then tomorrow is going to be a mind blowing mind blowing session because tomorrow there's so much I would add, right, from different angles. Tomorrow I'm going to add a whole lot, right, and then I'll teach you something from here. Let me give you guys a sneak peek of it. So this is like my MT4. Can you guys see my MT4 anyway? Yeah, I'm sure you can see it. Right? So if you look at my MT4, aside all the technical analysis I do, I always find entry and then hold trade based on what the market is doing for the week, right? So if you look at, so I always make sure that I find trades from extreme highs or extreme lows. If you look at this is basically the MT4, and then these dotted lines you're seeing here, they are period separators, right? They call them period separators, right? And then when I'm on the 4 hour, every price separator here you're seeing is the markets trading within a week, right? So this was what happened on Euro New Zealand dollar last week. This was what happened last 2 weeks. This is what happened last 3 weeks. This was what happened last 4 weeks, and so on and so forth, right? So everything you're seeing here is what week by week by week by week by week, right? Is that clear? Is that clear? Exactly. I just want to, yes, okay. Since somebody says it's clear. Now, fine, fine. You're seeing all these dotted lines, week, 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 is it? And then remember, we're on the 4 hour. we're taking an entry confirmation predominantly from the 4 hour. You can't take an entry from the 4 hour and expect 10 pips, 20 pips. If you take your entry confirmation from 4 hour, minimum you should even anticipate with respect to market movement is 100 pips, right? Yes, there's 100 pips. I'm not going to lie to you, right? Except for some few pairs that are really very crawling pairs. So I watch a setup like Euro New Zealand dollar run all the way up, gets to this point, start to reject, gives me a confirmation, which we'll learn tomorrow. I find my entry for a short here. What happens? This is the beginning of the week, Monday, Tuesday, Wednesday, and I'm finding a trade here for a reversal. Obviously, somebody's sleeping. Tope Imano, wake up. Obviously, what this means is what for us to trade all the way down, right? It's going to take what the rest of the week, and this is what Monday, Tuesday, between Tuesday and Wednesday, we find our entry for a short here. The rest of the week is going to end here, right? Once the trade comes into my profits, I put my stop loss to break even. I am not touching this thing until the week ends. And how the weekend here? The same for this. Let's say what we push all the way down, we start to reject within this region. I find my entry here for a buy. I'm not closing this until the weekend. And how does the weekend? We push back up. You get it? So fine, I'll be doing my analysis on the MT, on the trading view, marking up the chart. But once I'm looking at the raw chart of the MT4, I pick my entry, knowing how the week is going to end, right? And how the market moves. So here we do what we find what the market rejecting in Friday, early Monday morning, pushes up, gives us a strong bullish confirmation. If we take a trade for a long year, leave that trade to run for the rest of the week. So Tuesday, Wednesday, Thursday, before you realize you're up about what? You're up about how much in pips from this region? 270 pips without doing anything, just because you understand what these period separators and then how the market respond based on what the technical analysis. I can show you so many scenarios from here, right? If you backtest this, right? So there are so many times that I held incredible trades, and then people wonder how are you able to hold this trade for so long like that? It's just from what I'm showing you, right? If I mark this range up like that, and then I have what my confirmation here for a long, and then my stop loss right beneath. I'm holding this trade from the beginning of the week, which is Monday, Tuesday, Wednesday, Thursday, whatever it is. How much in pips would that have been already? 270 pips. You get that? What's the number, please? We need. Okay, you guys are talking to each other, right? So yeah, that is a very good trade to help you hold trade. I'll show you how it coincides with our chart markups, right? So here I had a very interesting trade here within this period as well, right? Looking at the lows here, very early in the week, it was a Monday, strong bullish closure, found an entry here, held it for the rest of the week, about 600 pips before the week ended, right? Look at this. If you stand here to here, that's it. Can you see that? 600 pips. And I had this trade set up as well, right? With a very small risk. My risk was just beneath this range, 40, 50 pips for 600 pips, just because what I was looking at the market from what the weekly range, right? The same for here. If we had caught a sell here, we'll hold it for the week. You know, just like that. If we caught a buy here, we'll hold it for the rest of the week, right? So on and on, you start seeing the signs. But yeah, somebody says clearly, my eyes are open. So this is just on Euro New Zealand dollar, but you can backtest that on every pair. Look at Euro JPY, right? Midweek. Start seeing, this is the third touch of the trend line that I was showing you here. Do you remember this chart? This is it here. Euro JPY, and then this was it. This was the setup. So we're here, 0.1, 0.2, 0.1, 0.2, 0.3. We start rejecting 0.3 here. We'll be looking at how it coincidentally plays out here as well. And then that rejection is here. We find an entry for a sell here. What happens? We have to leave it to run for the rest of the week. And then even if you left it to run up to Friday, what happened? About 120 pips booked. If you lose some partial profit, left it for the continuation of the next week, then you have about 200 or 300 pips, right? So as far as the trend goes, once the stop loss are break even, you book partial profit. So you can have insane setups by just looking at the market this way. Look at this one as well, right? Rejection from this range. The week begins. Find an entry for a short here. When you learn candlestick formations, it will even make this one way easier, right? When you even learn the candlestick confirmations, right? If I show you what I look out for at bullish reversal, bearish reversal, lower high low formations, what I look out for, it will even make what trading like extremely easy, right? If you back test into it, right? There's so many scenarios. We had this trade set up as well, right? So we started rejecting from Friday, and then early Monday morning confirmation was hit, stop loss above the range. What happened for the rest of the week? A massive drop. Can you see that? And then what? 300 pips. So I hold a trade for a weekend, and you're wondering how is it could you hold on the trade like that? It's because of these little tricks that I've shown you guys, right? Because of these little tricks, and then I can hold this kind of trade from here, right? Imagine holding this trade even all the way from here, right? Run up the next week, continues the next week, continues before the market will start rallying up. You have like over 1,000 pips on a single position just because you are watching it from a more clearer perspective or clearer view, right? Can you do that on trading view? It's not convenient doing that on trading view. It ends up putting so much lines on your chart, so I avoided doing that on trading view. That's why I do that on the MT4, right? It's not convenient doing that on trading view, right? It puts too much lines. This setup was also another prime setup, right? This was the one that I was showing you guys. This one had also a third touch, right? 0.1, 2, 3. What do you do? This was a breakout candle confirmation within this range. You find your long, and then what happens? You're watching the market from this range. You hold the setup, boom, 240 before the week ends, right? Insane insight, right? Just this week, and you bank incredible. I'm going to end here. I'll catch up with you guys tomorrow. We go deep into the candlestick confirmations, talk about cross-referencing, correlation, and then we see the fundamental and how they also affect the market. So do backtest what you've learned, and yeah, again, practice makes perfection. So I'll leave you guys here. See you tomorrow.